Nice to have you with us on this Thursday. Let's take another look at those U.S. futures with 30 minutes to go before the bells ring. Lots on the docket today. We mentioned the debt ceiling, latest in D.C. We've got lots of retail earnings, which we'll continue to dig through. Some private sector jobs data in the U.S. ahead of that key employment report tomorrow. Now, with the first couple of quarters of the year in the bag, let's review the Canadian market reality. We are up this year, but not much. A lot of tech stocks doing well, but for example, the TSX overall rising less than 1%. As we have rolled through the year. And perhaps more notably, the three groups that carry the biggest influence, energy, financials, and materials, have been a drag of late. The pundits touch on a range of reasons. Oil, we know, has slumped on global demand worries. Banks are down on lackluster earnings. Within the materials sector, yeah, we've seen some gains in gold, but those have been offset by some struggling stocks like Nutrien and Canfor. But there's also a view that cyclical stocks do the best when we are coming out of a downturn. And as many of the headlines have suggested, we could be headed towards a downturn, but we don't seem to be quite there yet, at least if you're measuring data points like the GDP numbers that we saw yesterday. So against that backdrop, let's talk a little bit more about the investing landscape and the economic outlook. Candice Bangsund, Vice President and Portfolio Manager at Fiera Capital, joining us here in studio. So nice to see you.
You as well. Thanks for having me.
A lot of big questions, I guess, as we get ready for the second half of the year. Let's just sort of take stock of where, in your opinion, the economy is right now.
Yeah, I mean, the economy has been resilient, in fact, and this is actually creating some complications for the central banks that are trying to bring inflation lower. So this is why it's a bit of a double-edged sword. You know, you get these strong GDP numbers. The economy is still operating much too strong to break the back of that very strong inflation. And
so I guess what is the biggest complicating factor? Is it inflation at the end of the day, would you say?
Yeah, absolutely. I mean, our outlook really hinges on the outlook for prices and the response from central banks. And the problem is that core inflation remains extremely elevated and far too elevated for central bankers' comfort. And this is why central banks need to apply more pressure on the economy in order to bring those core inflation measures back towards levels that they're more comfortable with, towards the 2% mark. And this is going to prove extremely difficult given the underlying strength of the labor market. Unemployment is still at rock bottom levels. There are a lot of shortages, imbalances in the labor market that are propping up wages. That's what's keeping core inflation elevated and persistently sticky.
And this seems to be some, you know, when we talk about central bank strategy, or let's say what the Bank of Canada, for example, is doing, because when we had that stronger than expected inflation report recently, and then yesterday we had you know, to your point about a resilient economy, some pretty good indications that we're still chugging along here. Some people said, okay, well, maybe the bank is going to raise rates again in June after being on the sidelines for a couple of months. Then some people said, well, hold on a second. You know, these rate hikes actually do have a cooling effect over time. We just don't know when.
Right.
So maybe they continue to sit on the sidelines. But I guess that speaks to what that balancing act you were getting at.
Yeah, absolutely. And I mean, our view is that, you know, given the data points that you mentioned, and even the upcoming labor market report that'll be next Friday, you know, I think this is going to increase the likelihood that the bank steps off the sidelines and raises interest rates again. We have a few more rate hikes from the Bank of Canada as well as the Federal Reserve in our projections over the coming months.
Over the coming months. So I guess then it wouldn't surprise you that we've seen a bit of a, I mean, outside of technology, which is its own storyline, that we've seen a bit of a stall out in the equity market?
Yeah, I mean, the story in stocks this year is, you know, it's a bit misleading when people talk about the strong stock market. It's basically a handful of mega cap tech stocks that have been driving the rally, driven by a decline in bond yields. You know, looking forward, given the outlook, you know, for a difficult economy, more central bank tightening that inevitably raises the chances of a hard landing, the outlook for stocks does not look all that bright.
And when it comes to that landing, do you have a current view on what it is? I feel like we've now spent 2 years trying to determine what a soft landing or hard landing looks like, whether we're going to get there at all. I mean, everybody's got an opinion these days.
Yeah, absolutely. So we're, you know, regrettably in the hard landing camp. And that really...
So you're worried, basically.
Yeah, and that stems from the fact that we do think central banks have more work to do in the fight against inflation. We've also got banking stresses that acts as its own restraint on the economy. So together, I think this raises the likelihood of recession likely towards the end of this year.
And is that a Canada story? Is that a U.S. story? Is that a combined North American story? Is it a global story?
It's really a global story. I mean, ex-China, of course, but in the U.S. and Canada, similar stories. Inflation still persistently elevated, not consistent with levels that central banks are targeting, reinforcing the need for more action to inevitably, apply some pressure, create some demand destruction, and get that inflation back moving lower. Of course, there will be spillover effects as well from the U.S. towards Canada as well. We're seeing similar trends in Europe, where central bankers there are just as hawkish.
Before we take a quick break, we mentioned that debt ceiling deal in the House in the U.S. If we were talking about a U.S. default, would that further complicate things? I mean, is this a good development? Is it a market already sort of was hoping this would happen?
Yeah, I mean, I think the expectation, using history as your guide, is that, a deal always comes through. So it's definitely good news. It's created a lot of noise, obviously, but now I think the focus is going to revert back to the macro landscape, the outlook for inflation, central banks, and of course, the economy.
All right. Well, I know you're